The money in your bank account doesn't really exist. This is not a metaphor, and it's not a conspiracy. If everyone went to their bank tomorrow to withdraw their cash, the system would collapse within hours, because the money simply isn't there. This isn't a mistake. It is the deliberate design of the modern financial system, a mechanism centuries old, so normalized that it is rarely questioned. It's called fractional banking, the quiet engine behind global debt, inflation, and the illusion of prosperity. To understand this story, we have to return to a world before digital numbers on a screen. In medieval Europe, money was gold and silver. Wealth meant coins in chests, jewels traded by hand. But carrying gold was dangerous, so people began entrusting their valuables to goldsmiths, men with secure vaults. In return, they received a receipt, a simple piece of paper, yet that paper was accepted as readily as the gold itself. That was the turning point. The goldsmiths noticed something. Not everyone came to claim their gold at the same time. Out of 100 people, maybe 1 or 2, the rest of the gold sat untouched in the vaults. And that's when an idea was born. They began issuing more receipts than the gold they actually held. They lent out gold that didn't exist at interest. As long as no one demanded everything at once, the illusion held. Money had been created out of nothing. This small trick changed the course of history. Paper claims overtook physical reality. Banks institutionalized the practice. States embraced it. The founding of the Bank of England in 1694 symbolized this shift. Its purpose was not to serve the public. It was to finance a state drowning in war debt. The government borrowed money it did not have. Future generations paid the price through taxes. Sound familiar? Because the same thing is happening today. Over time, gold disappeared from the equation. All that remained was trust and numbers. Today, banks do not lend out money from their vaults. They create loans first, and the loan creates the money. When you take out a mortgage, the bank doesn't open a safe. It types numbers onto a screen. That money exists for one reason only: your promise to pay it back. Most of the money in the modern world is not printed by central banks. It is created by commercial banks out of debt. That's why every financial crisis is ultimately a crisis of confidence. When borrowers can't pay, when banks can't roll over debt, the system begins to unravel. This design has unavoidable consequences. First, inflation. As money multiplies, its value erodes. Second, permanent debt. Because money is born as a loan, the system never closes. Third, concentration of power. Banks collect interest on money they never truly possessed. Governments finance wars, crises, and bailouts through this system. Asset owners benefit. Workers lose purchasing power. It was true in 1929. It was true in 2008. And the next crisis will be no different. Each time, the system is rescued. Because without this illusion, the modern economy cannot function. Here is the uncomfortable truth. The system cannot survive if everyone is debt-free. If all debts were paid tomorrow, the money would disappear. The economy would stop. You are both the fuel of this system and its collateral. That is why history matters. The small trick of medieval goldsmiths has become the foundation of global finance, and every crisis reminds us of the same lesson. Money is not wealth. Real wealth is land, knowledge, skills, and independence. Debt is not neutral. Inflation is not accidental. That is not a story meant to scare you. It is a call for awareness. If you understand the game, you can protect yourself. If you don't, you keep playing at a table where the house always wins. And remember, this story is not finished yet.